Here are your top 10 macroeconomic charts of the week, distilled down into one video. First, we have from Raoul Pal an overlay of the ISM, which measures manufacturing activity overlaid on top of an inverse chart of inflation in blue. You can see that they track each other pretty well. And so what is happening right now is the manufacturing activity is taking a nosedive. Once it goes below 50, we are in recession territory. That is what that extreme spike in inflation is causing, the blue. It's inverse. So when it's going down, inflation is going up, and that is pushing us directly into a recession. So we can see where the ISM is headed. It's headed to depression/recession territory because of this inflationary move. And so for that reason, the Federal Reserve has been trying to fight it by raising interest rates. But because of that, we have this chart from Ian Harnett showing the US unemployment rate. So we have that massive spike in dark green from the pandemic. Then we have a massive reversal in the US unemployment rate because the Federal Reserve stimulated and printed money to get us out of it. Well, now you can see how closely that tracks housing, which is the NAHB in gold. You can see how when that reverses, again, this is inverted. So when it goes up, housing is crashing. Well, look at how closely correlated unemployment is. This is not a good sign for unemployment. We are headed into a recession, if not a depression, depending on how things pan out. So we saw ISM collapsing. Now we're about to see the unemployment rate go up. So where does this all lead us? We know that interest rates are the oxygen of the financial system. When the Federal Reserve raises interest rates, the cost to borrow money goes up, debt becomes more expensive, everything you buy with debt goes down in value and crashes. So because everything is linked to interest rates, which are indirectly linked to inflation, the most important question is really, one, what is happening to inflation? Two, what is happening to interest rates? Well, now you can see this chart provided by, again, Raoul Pal, which shows ISM manufacturing activity overlaid on top of the US 10-year bond yield. You can again see they are tracking each other. When bond yields go up, manufacturing activity, the US economy crashes, causing a recession. So right now you can see they've actually diverged, which is shocking, but you can also see the last few times this happened, bond rates spiking. Look at every time the year-over-year change in bond rates hit 10%, you can see they quickly came down to earth due to a collapsing ISM. So the ISM is now collapsing. The US economy is now collapsing. Will bond rates collapse as well? And so that is what people are expecting. Because we're heading into a recession, rates will crash. Therefore, the Federal Reserve can finally use its tool, the only tool it has, which is to stimulate by lowering the federal funds borrowing rate. And the reality is that is what the US economy has been pricing in last week. Remember in the last video, I said we're due for a short squeeze bounce. Well, we got that bounce because the market incorrectly or correctly thinks that we've hit peak inflation. If we've hit peak inflation, the Fed can now stimulate. Bond rates will come down. Oxygen can be allowed back into the room so people can breathe, so the US economy can breathe. Well, that is what got the markets excited last week. So the real question is, what is next? So you have this from Tavi Costa, issuances of treasury bonds. Look at how historically massive the issuances of treasury bonds have been in the last 2 years. This tells you everything about markets. So you have this massive spike and you have a massive spike in all risk assets, including the ARK ETF and crypto, right? Now you have this small blip on its road to epic issuance. So that is what the market is hoping for. They want this line to keep going up because inflation has theoretically peaked. That's what they're thinking. And so they think bond yields are going to crash. If that happens, the Fed can stimulate and print even more money to get us out of the nasty recession that we are facing, that ISM, unemployment, and housing is all pointing towards. So we're heading into a recession. Will this white line be allowed to go back up? It's only going to go back up if inflation has peaked. The market thinks it has. And so the real question is, has it? Now, that is a hard question to answer because it's data dependent. You need to wait for the PPI to come out. You need to wait for all the indicators to let you know if it's peaked. The market thinks it has, right or wrong. And so that's why we're in this bounce. And so what you want to look for to answer that question is commodity prices. Right now, they have been in a dip. Commodities are inputs to the economy. The cheaper they are, the less inflation we're going to have. And so they've been dipping. It's possible we have peaked. It is possible. Now, the real question is, well, what happens if more geopolitical turmoil and supply chain disruptions happen? What happens if oil continues to spike? These are the great questions of our time. In the meantime, we have these macro charts to look at as indicators. So you can see we're way ahead of ourselves. US 30-year mortgage rate, year-over-year percent, absolutely at the floor. And you can see how it tracks ISM. Well, ISM is plummeting. So are we due for a quick bounce because the market seems to be happy a little bit about where we are? Probably, maybe a little normalization in the short term until we get the next inflation reading. And so now let's talk markets, right? What is next? What is ahead of us for the stock market? Well, the NASDAQ has already seemed to price in a crashing ISM. Look at how closely correlated they are. The NASDAQ has gone ahead of itself. The NASDAQ is expecting and pricing in recession, if not depression. Look at how deep it is. Hasn't been this low since the pandemic, but also the 2008 financial crisis. So we could get some normalization here. We could get a bounce back. So now let's look under the surface. Let's look at the guts of the market. So are stocks near a bottom, at least short term, until we get the next inflation reading? Well, we have this from Holger Japetz. So what you're seeing here is the equity fund managers' positions in cash. Look at it's at an extreme level. The market is extremely bearish overall. And normally there's only one direction for this to move. As you can see, every other time it's hit this level. Now, obviously it could hit 2000, 2001 metrics, but I wanted to show this to you as an example of how skewed we are. If everyone is bearish and crowded in one direction, then everyone normally gets squeezed. That's just how markets work. And you can obviously tell by this chart, every other time it's at this level, there's been a correction. So are we due for a bounce? Possibly. But what makes me think we're going to have another shakeout is this chart. Retail traders bought nearly $1 billion in crypto stocks over the last 10 days. The little green bounce in crypto caused retail traders to chase the chart. And so here we have more frenzy. A little bit of green caused a massive rush in. And so we haven't seen this since late 2020, maybe because everyone is skewed in one direction. The retail traders could be right for a time. Maybe we'll get that short-term bounce. But normally when retail traders are this skewed, we're due for more downside. And I could absolutely see that. This chart says a lot. This comes from Alessio. So white is the VIX volatility index overlaid on top of the S&P 500 in blue. Normally what happens is when the market is extremely afraid, this spikes. And so what we're seeing right now is very little activity in fear. And so lots of people are saying, well, the market isn't afraid. The market isn't worried. Maybe there isn't anything to worry about. If you look at the UVXY index, this gives you a good indicator of how afraid people are. Well, look at the last 6 months. It's literally in the floor. So that's where we are now. And if you take a look back at the global recession financial crisis, you can see that it did the same thing. Here's a chart in white showing the VIX, blue showing price action. So the VIX collapsed in 2008. You can see how it went down prior to the meltdown in later 2008. So the VIX is not an indicator of where we are. What it's showing is complacency. The market is still complacent. They're pricing in peak inflation. They're pricing in a nice short-term dead cat bounce relief rally, but it's an indicator. You can see how complicated this is. On one hand, everyone is in cash. On another hand, no one is afraid based on the VIX index. But what I'm seeing, what I'm starting to sniff out here is that we're going to get a dead cat bounce relief rally in the markets to make everyone rush in and get suckered in. Because if you look at this chart, you can see how difficult it was to trade that market in 2008, which was obviously an epic collapse. You can see sucker rallies that caused the VIX to crash in white and the blue to go up, but that was an incredible shorting opportunity. And so there's more room to the downside. Obviously, if you look at this chart, this is a measure of the S&P 500 bear market. So currently we're only at 23.6% compared to all the others. The non-recession mean was 28%. The recession mean was 35%. So there is more room down to go. All I'm saying is that since the market is pricing in inflation, there could be a nice relief rally here for risk assets. And I would call that potentially a sucker's rally. And also don't forget that the NASDAQ has already corrected so much. Normally it's more correlated with the ISM. So that's the summary. I think that's the key takeaway from all this. You guys tell me exactly what you think. But I think when you look at how oversold the NASDAQ is, when you look at how the market is starting to price in peak inflation correctly or incorrectly, that's what the market thinks. When you look at how we have months of this ahead of us, when you look at how skewed cash is, when you look at how excited the retail crowds are, you could see it has the makings of a potential relief sucker rally. And we will stay on top of this data. That's what's so crucial about understanding these markets, is looking at these charts. And so that was your top 10 charts of the week. But because I love sharing this information with you guys so much, here is one last bonus chart looking at net positioning in gold. Net positioning in gold has gone negative, deep negative, for the first time in a while. Look at the last time this happened. It doesn't happen very long, but just an exciting moment if you're a gold bug and seeing this. But also, if you're a contrarian investor, this should excite you greatly. And so again, even the gold chart points to a potential rebound because gold is tracking the rest of the market and is correlated. So that is the update. Thank you guys for watching. Such an exciting time. You guys tell me if you think there's a relief rally ahead. I can foresee that, but obviously no one knows for certain. We will continue to stay on top of this market. This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky and you can lose lots of money in them.